A stock market is the place where shares of publicly traded companies are bought and sold. This buying and selling often leads to fluctuation in stock price. Moreover, these companies are registered at a particular place called exchanges, including the National Stock Exchange and Bombay Stock Exchange, for people to buy or sell. The investors purchase those shares, which allows the company to raise money to grow its business. Stock market does come with risks, but with the right investment strategies, it can be done safely with minimal risk of long-term losses. In this course, we will learn about what exactly is a share, what are stock exchanges, as well as how stock markets work. If this tickles your interest and curiosity, then stay tuned to learn more about the stock market through an informative session that lies ahead of you.
If you haven't subscribed to our channel yet, we request you to hit the subscribe button and turn on the notification bell. This is done to make sure you don't miss out on any of the new updates or video releases of great learning. And of course, if you enjoy this video, show us some love. Do like the video. Knowledge increases by sharing, so make sure you share this video to your friends, family, and whoever can make use of it. And at the end of it, make sure to comment on this video if you have any queries and suggestions, and I would be more than happy to respond to all of your comments. Before moving on, let's talk about some of our learning objectives. So we will start this session by knowing what is stock market, what are the different terms and terminologies that are used in stock market. Now, the second point that comes into picture is knowing what exactly is share, how are shares rolled out in the stock market, what is the process involved in it. Then we'll talk about the two major stock exchanges in India where companies are bought and sold, that is the National Stock Exchange and the Bombay Stock Exchange. Moving forward, we will know the basics of share market. What does that mean? That means the common jargons that are used in stock market that we commonly hear when we turn on the television or a business channel or a business newspaper for that matter. Then we'll know about the process in which these companies are listed on stock exchange, which is called as the initial public offering. We'll know that in a greater depth. Moving forward, we'll know what type of investor are you? Are you a trader or an investor? What is the difference between the two, and what other type of trader are you? So we'll talk all about that in this particular session. Then we'll know about how are companies fundamentally analyzed. What is the thought process behind that? What are the key components that you need to know to analyze a particular company? Then we'll talk about certain questions that keep coming up when we talk about share market. So all that thing is included in this particular course. So make sure that you have your notebook and pen in hand, because this session is going to be a knowledge packed session. So without any further ado, let's get started. Now, before starting to know what exactly is stock market, I would like to ask you one simple question. Do you know which was the first ever company that got listed in the stock exchange? It has a very significant history attached to it, but stay tuned till the end of this module because I'm going to give you the answer at the end. So let's get started by knowing what exactly is stock market. Now, when we talk about stock market, it is generally the place where publicly traded companies are bought and sold. And when I mention the word publicly traded, it does not mean that the government is controlling these companies. It's not a public sector company. It generally means that a private company is now open to the investments by the general public, which is why it is called as publicly traded companies, in which the investors like you and me, which we often call as retail investors, can put our money in order to expect a good returns out of it. Now, we can address stock market as a mall, right? As a marketplace. Just like how a mall has different shops of different brands, similar to that, a financial marketplace or the stock market has different brands as companies in which retail investors like you and me can go and pick and choose which company you want to put your money in, right? In order to gain hefty returns at the end. These companies can be bought and sold into two such exchanges in India. There are many more, but two prominent ones are the National Stock Exchange and the Bombay Stock Exchange. Now, the investors purchase these shares, which allows the company to grow its business. I'll just give you a hypothetical example. Let's say that you are starting your own company. right? So you would have very little capital attached to you, but you would have the majority part of the company. Let's say you are owning 100% of the company, but you don't have that much funds, right? So you would be open to investments from other people. So these other people would demand a percentage of your company, let's say 5% or 6%, right? Which is called as initial series funding. So it is series A, series B, series C, series D, and many more series of funding in exchange for the little ownership that you would grant them of your company. Now, what would happen is that there would be a certain stage in your company when you want to grow your business at an exponential level, but you don't have that much funding attached to it. Then, what would be the way out? In that case, you would list your particular company in a stock exchange in order to get more money or more funds from the retail investors in return of a part ownership of your company, right? In this way, a company gets its funds to invest its money. In this way, the company generates more funds from the general public in order to meet their capex requirements. Now, what is capex? It means capital expenditure. That is a plan that the companies chalk out for their future expansion, right? Or if they want to get into another country, they want to start a new venture out of it or a new entity out of it. This is how they do it. Now, we have often heard our parents or our colleagues tell us that, you know what, stock market is a very dangerous thing. It is a thing that you should not put your money in. It is a very risky affair. We can all agree to that. We have heard it from someone or the other in our lives, right? So if it was such a dangerous thing, it was a thing that nobody should touch, why hasn't the central government or the Reserve Bank of India already banned such thing? It has some interesting thing attached to it, right? It has something that will improve our life eventually. That is why they have still continued stock markets in India, right? To move the global economy forward. Now, this very question, that what is the need to invest, keeps buzzing us all day. So I will give you a very simple example for it. But before that, I often get reminded about the one particular quote from the legendary investor Warren Buffett. If you can't figure out to make money while you sleep, you would have to work each day of your life. Now, with that thought in mind, I would like to say that by investing, you can deal with unavoidable situations like rising living costs. Now, if you are just a fresher out of college, or if you're just looking for a job, you would know that shifting to another city or shifting to a place outside home is a very, very expensive thing. Now, in order to deal with that, now this would be a major problem, right? Now, in order to use that, you would have your savings. You would save, let's say, 20,000 a month, or let's say 10,000 a month. Now, what do you think? That 10,000 will remain of the same value as it is today in the next 5 years? No, right? The reason is one particular thing called inflation. Now, inflation is something that we can't control. This is something that the global economy controls, or the policies of the government control. Now, what would happen if you would have noticed that prices of everything post COVID have dramatically risen? And the reason for that is the low interest rate, which leads to higher inflation rates, which is why it becomes increasingly important for us to know that the money that we are earning right now, the money that we are saving right now in our bank accounts, is not sufficient to sustain a life going forward. We would need to put our money into certain investment instruments, which we will be talking about in greater depth going forward. Now, by investing, you can hope to have a larger sum of money at the conclusion of at your retirement age or something, to fund your after work life, right? So that is also one of the most important reasons to invest. Now, people want to be financially protected, right? You don't want to have emergency situations in which you are out of money, which is also the reason why you want to put your money in certain instruments like equity stocks or mutual funds, or debt funds. We'll talk about that going forward. Now, apart from it, we also have certain goals and ambitions in life. We also want a fancy car. We want a fancy house to live in, right? To fund all of these things, it is possible in a minimum income, if you know how to put your money at the right place at the right time, right? So all these are major reasons for you to invest in the stock market. No doubt that it is very, very risky. It is a place in which you need to have a lot of knowledge to get into. but still you can make a lot of money out of it as well. All right, now let's talk about the different types of financial elements, or we can say financial markets, that are present in the world, right? So we'll start with knowing what is stock market. So the first type of market is called the stock market. Now, since this particular course is based on stock market, I'll tell you about it in a greater depth going forward. But to know about the other markets is also an important thing. So I'll give you a brief idea of what type of other markets are present, right? The second type is the bond market. Now, bond market includes retail investors like you and me giving our money to the government or certain corporations. In return, they give you a particular certificate stating that you have invested XYZ amount in particular government or the corporations in return of a particular interest amount. Now, that interest amount can be varying. It can be from as low as 3% to as high as 10%. But that depends on the time and also on the interest rates. So, bond market, why would people invest their money in bond market? Because it is relatively less riskier than the stock market. So people tend to minimize their risk when they buy these bonds, right? The next type of market is called the commodity market. Now, commodity market involves the buying and selling of agricultural goods or certain things that can be mined like gold and silver, right? So this is called as a commodity market. Now, the commodity market is divided into two components. The one is called hard commodities and the second is called soft commodities. Now, hard commodities involves things that can be extracted and mined like gold, silver, rubber, etc. Right? Soft commodities, on the other hand, includes agricultural goods and livestock, right? Like barley, rice, and all that stuff, right? So the trading of all these things are comes under commodity markets. Then comes derivative market. Now, derivative market is one of the most riskiest type of market that ever exists. So in this particular market, what happens is that you are buying an underlying asset of a particular company, right? Which is called futures and options, right? So in futures, what exactly happens in derivative market is you basically buying an underlying asset, a small part of the original share, but in future. So let's say you are buying for a particular price 2 months in advance. So that is called as derivative market. I'll not get into too much depth about what derivative market is because it is a subject on its own. To give you a brief idea, this type of market is very, very risky, in which you can lose all the money at once. If you have heard stories when people say people losing all their money, this is the reason why they lose a lot of money, which is derivative market. At the end, we talk about what are cryptocurrency markets. Now, cryptocurrency markets, we all know, are in a lot of hype these days, right? So this was involved buying and selling of cryptocurrencies like Bitcoin, or you have other type like Doji coins and all. So all the meme coins that are coming into picture, all the coins that already exist like the Bitcoin. So all these coins are daily sold and bought. So this comes under cryptocurrency market. Now, cryptocurrency market is technically an investing instrument in India because it is not a legal tender to buy and sell a good or a service for in exchange of cryptocurrencies. But people buy it thinking about it is an investment asset, right? All right. Now let's talk about greater depth. What exactly is this course about? That is stock market. At the start of this course, I asked you one question, right? What was the first company that ever got listed on a stock exchange? So the answer is Dutch East India Company, the same company that later came to India. So around 1600, this company got first listed in Amsterdam Stock Exchange, which is, by the way, the oldest stock exchange in the world. Now let's move on to knowing what is a stock. Now, stocks or shares are a small part of ownership in a financial asset or a business entity. Now, what does it resemble? So, as the name suggests, share represents something that is being shared by everyone, which is the part ownership in this particular case. So, people who buy these shares are called shareholders, and the company divides its total capital into small chunks, small parts, right, of equal value, which is called a stock. So the main reason, right, you would want to know, why does the company issue stocks? What is the reason behind it? Now let's just take a simple example. All right, let's say a company is in a shoe business and it has funds of 10,000 rupees, to make, let's say, 100, or let's say 1,000 shoes. Now, for this fund is limited Now this fund is only for a month, right? And it can make only 1000 shoes out of it. Now let's just assume that a company got a very big order from someone, right? And the total requirement for completing that order is 50 lakhs. Let's just assume it. Okay. Now it does not have funds, right? It does not have funds that it would need to make that amount of to complete that particular order. So in that particular case, what would happen is that the company would give part ownership to general public or retail investors like you and me. So it would divide those 50 lakhs, it would divide the 50 lakhs into small chunks. Let's say it divides it into 10 rupee chunks, which comes out to be around 5 lakh shares, right? So this 5 lakh shares into 10 rupees per share, it will roll out. Now this amount is not fixed like 10 rupee. It can roll out 50 lakh shares with 1 rupee face value. Face value is this particular amount that is set. Now it can be 10, it can be 100, it can be 1. It depends on a variety of reasons, the valuation and everything. So we won't get into that. But in a general sense, this is how a share is created, a stock is created. Now, then it is listed in the stock market and you have XYZ amount of shares that you can buy. Now, how does the price of it increase or decrease? That is completely dependent on the demand and supply of that particular share, right? So if the demand is high, if the supply is high, depending on that, the price of that particular stock increases or decreases. If the stock price of that particular company increases, then it utilizes those extra amount and gives you back as dividends, right? So this as dividends. Now let's talk about the benefits of investing in stocks. Why would you as a retail investor put your money, your hard-earned money into share market, right? So you would want to know what are the key benefits that it provides. Number one is capital gains. So what does it mean? It means that if you've invested in particular stock, let's say you have taken 20 stocks for 100 rupees each, right? That would be you spent around 2000 rupees. Now the value of this 100 rupees in, let's say, 2 years went to 1000 rupees. Hypothetical example. So what would that mean? So that would mean your 20 shares would now be worth 1000 rupees each, right? That would be 20,000 rupees in your pocket. Now, if you know what would be your profit in that, your profit would be 18,000 rupees. Now, with that amount of profit, you would definitely would be willing to put your money. You have 2000 and you're getting back 20,000. That is a great deal, isn't it? So the first benefit is capital gains. Number two is dividends. If the company is performing at an exponential rate, if it is performing very well, it is generating extraordinary returns, what would happen is that the company would want the investors like you and me to stay in that company for a very long period. So in order to do that, it would divide those profits into small chunks and distribute it among the shareholders. That is called as dividend, right? Third is the ownership. Now, when you're buying a certain stock of a company, you would also have the feeling of ownership to that company. So you own a part of that company, right? You can go around and say, I have 20 stocks of Tata Steel. I am a part owner of that company. So that is called ownership. Next comes is the voting rights. Now, when you are buying shares, right, you would also be given the voting rights to choose the management or the board of directors of that company. That is called voting rights. So that also comes up when you invest in stocks. Then comes IPO profits. Now, what is IPO would be discussed a little later, but I will tell you what is IPO profit. Now, what exactly happens in an IPO is that you are buying a lot of shares. A lot means a lot may consist of 20 shares or 50 shares. That depends on company to company. But you would buy a complete lot of shares for a particular predefined value. Let's say you are buying 50 stocks for 100 rupees each. So you are putting 5,000 rupees as your capital. Now, after this is before the company is listed. When the company is listed, let's say the price that is defined by them is, let's say, 500 rupees, right? Now you would instantly gain 50 into 5,000 rupees. That would be 25,000, right? you would have almost 5 times the amount that you invested in an IPO. That is called as IPO profits. So these were the benefits of investing in stocks. All right. So the next module that we will be talking about is what is a stock exchange. But before understanding stock exchange, I would want to explain you what are the two types of markets that the investing worlds deal in. That is the primary markets and the secondary markets. Now, if you talk about the primary markets, when the company raises fresh securities or part ownership. Now, what does this mean? You would have noticed that Flipkart recently got sold to Walmart. Majority of its stake got sold to Walmart. Now, this did not happen through stock market. This happened outside the stock market, in which a very big firm or a firm with a lot of money puts or buys a part ownership in that company. Now, this happens outside the stock exchange, hence it is called as primary markets, right? So securities are created in the primary market. Firms sell new stocks and bond to the public for the first time in this market. Right? So this is all about primary market. The second type of market that we are talking about is called the secondary market. Now, secondary market is also termed as the stock market when it comes to purchasing different stock or equities. Now, I would like to tell you that this stock market is for retail investors like you and me. If we want to buy a small chunk of that company, which is usually less than 0.00001% of that company, we go through this route, which is called as secondary markets. Coming on to what is a stock exchange. Now, stock exchange is a marketplace or a bazaar, we can say, for the stockbrokers and the traders to buy and purchase all the assets, that is, stocks, bonds, currencies, and other financial instruments like derivatives, etc. Now, this happens through stock exchanges. Now, in a layman's term, I would like to tell that stock exchange is basically like a mall that we all visit. Just like in a mall, you have different brands in different shops. In the same way, stock market is a financial market or a financial mall in which you have different companies that are listed in exchanges. For an India's perspective, we have two major stock exchanges in India, which is called the National Stock Exchange and the Bombay Stock Exchange. So most of the companies are listed in these two stock exchanges only. Now let's look at how does the stock market actually work. So stock market consists of three key players. Number one is the stock exchange. Second is the stockbroker, and the third is us, that is retail investors. Now let's look at the work of all these three entities. Now, when we come to stock exchange, the major work is to get the company listed in that particular platform and to maintain a depository for the same, right? So there are two major depositories in which your stock gets stored. Number one is called CDSL, which is called as Central Depository Service Limited, and the second one is NSDL, National Securities Depository Limited. So these both entities store your stock or shares. Now, what is the work of a stockbroker? So stockbrokers are listed on repeat. Now, stockbrokers are the members of stock exchange that conducts the trading on the behalf of a retail investor to put their money in the stock exchanges. Now, basically, they are called as dalals, in which because they move money from one party to the other party. That's their work. Now, when we talk about why we need stockbrokers, is because they make the work more fluid. Since India follows a T+2 settlement period, which means that if you are buying a particular stock today, you will receive that particular stock at the end of 2 days. So this type of thing can be very, stressful for a retail investors that does not have much knowledge about the financial market. So in that scenario, it becomes essentially important to have stockbrokers that would help in the transactions that you're making from your side to the company side. Now, stockbrokers are many that are there in the market. It is ever growing. Post pandemic, it has sky boomed the number of players that are in the brokers business. You would have ICICI Securities, SBI Securities, HDFC Securities, you have Zerodha, you have Grow, you have tons and tons of different brokers that are currently available in the market. Now, when we talk about retail investors, so we as retail investors, what do? We open an account with a stockbroker. So We open an account with the stockbroker, we give them our money, and then we decide which stock we have to buy, either by phone or today everything is on internet, so every transaction can be made online. Now when this happens, you have to have a bank account, right? Bank account is a must. So you need to have a savings bank account in which you have all the money stored. Now this bank account is one account that everyone holds, right? On the top of it, for trading in companies, you would also need a demat account. Okay. Now demat account holds the number of shares that you are currently having. So it is stored in CDSL or NSDL that we already discussed. But what happens that on your side where your stock is there, that would be your demat account, right? And then you have a trading account in which all your securities can be sold or bought at any point of time during the market hours. All right. So this is what happens. Now in India, the market timings are from 9:15 a.m. to 3:30 p.m. from Monday to Friday. And there can be a lot of holidays in between. That is another story. But mostly it operates from Monday to Friday for equities in from 9:15 a.m. to 3:30 p.m. We have already discussed what is the need to invest from a retail investor's point of view. But now let's look at the benefits that the companies get when they list their particular companies on the stock market. Now, the first point that I would like to tell you is that this helps in raising funds. As I already mentioned, there's something called as capital expenditure that the companies look forward to, and the companies make a plan. They chalk out a plan where what amount of funds are needed for what amount of projects, right? So all these things are taken care of in their capital expenditure. Now this also acts as an exit route to the existing investors or the promoters if there are any. So what happens is when the companies list a particular stock in the stock market, then what happens is that there might be some investors or promoters that want to leave the company, so they would exchange or they would get out of that particular company by leveraging their particular portion or the part ownership that they have to the stock market, to the secondary markets. The second point now is that for raising further capital for the future development of the company, as I already mentioned before, capital expenditure, if they are opening a new branch in a particular city or they're expanding globally to a new continent or to a newer country, this is what listing on the stock market is what helps them achieve that goal. Then it leads to the liquidity of the security. So it tells you how much liquid, how much, now it tells us that if the company is going to be bankrupt soon or not. If they have enough cash, if they have enough liquid money attached to it, then the company is in good hands, right? It also depends on the nature of the management that is handling that particular company. Then it reflects a true and fair price of the stock. Now, as a company, you would always want to know the clear or to a true picture to its consumers, that how does the company look like, how are they a growing company, are they a valued company. So all these things tell us the what is the fair and a clear picture of that particular company. So this is why it is the fourth point, reflects a true and fair price of the stock. So the next module that we will be talking about is called the basics of a stock market. Now there are certain commonly used jargons that we hear on a day-to-day basis, right? So let's discuss some of them. So the first one is called the bull market. Now bull market is a market when the prices of the stock are in an upward trend. What does upward trend mean? It means that on a month-to-month basis or a week-to-week basis or a day-to-day basis, the price of that particular stock is increasing than the previous day or the previous month or the previous week, in whichever time frame you are looking at the stock at. So this is considered as a bull market. Now the bear market is considered when all the trend lines are falling downwards. The stock is not performing well, its value is decreasing month on month, year on year, week on week, and day on day. So this is termed as a bear market, right? So now the fluctuation in prices, right, it depends mostly on the supply and the demand, the bull side and the bear side, the people who are selling the stock and the people who are buying the stock. Now, we always hear in news that the bulls have taken over the market. It means that there's a strong momentum going towards an upward trend, which is why it is called that the bulls have taken over the market. Now, when the stock market is in the downtrend, then we generally refer to as the bear market. The bears have taken over the market. So these are the two commonly used terms. Then is called the face value of a stock. As we already discussed before what it is, I'll reiterate it. So for example, if a company needs a 50 lakh rupee, repeat, 50 lakh rupee is their capex or their capital expenditure requirements, then what would they do? They would generally roll out 5 lakh shares of 10 rupees each. So this 10 rupee is 10 rupee per share. So this 10 rupees called the face value of that stock. Now next comes 52-week high or low. Now 52-week high and low generally means that the highest value of that stock that has been achieved in 52 weeks, or basically in an year. Similar to that, the lowest price that the stock has achieved in 52 weeks or 1 year is called 52-week high or low. Next comes the upper circuit and the lower circuit. Now, as I already mentioned before, so there is a governing organization called SEBI, which is called Securities and Exchange Board of India. Now, this particular organization is run by the government. It's a regulatory body which takes care of all the trading that happens in the markets. Now, money is a very sensitive issue. Now, it can lead to a lot of malpractices or fraudulent behaviors that we would see in the market. So, in order to curtail that, in order to maintain the decorum of the markets, so SEBI regulates most of these things. Now, one of these things is called the upper circuit and the lower circuit. Now, what usually happens is that the government does not want the investors to lose a lot of money. Just imagine a situation in which a company is trailing all good, then suddenly a news comes that the entire management has resigned from the company. What would happen to that particular stock? Everyone would keep selling that stock. The reason for that is they do not believe in the company anymore. They would not believe that if the company would exist in the longer run, and their money would not be given back to them. So in certain cases, the prices of that particular stock would fall rapidly. It would crash, right? So in order to protect that, there's a limit to which it can go up or down, which is called the upper limit and the lower limit. So from a fresh day, a fresh limit is set. It usually is in percentage, like 10 to 20% of the stock's value or something like that is the upper limit and the lower limit. So when that particular stock hits that particular limit, right, then the trading stops in that particular stock. Either ways, upwards or upper circuit or lower circuit does not matter, but the trading stops if it touches that limit. So in order to protect the retail investors, in order to protect the money of the retail investors, this is what the SEBI regulates on a day-to-day basis.
So the next module that we will be talking or discussing about is called the IPO markets. Now, we have had a brief discussion about it in the previous modules, but in this particular module, I'll give you an overall outlook of what IPO is and also know about a case study of Zomato. So let's get started. So IPO basically stands for the initial public offering. Now, what happens in this particular scenario is that privately held companies offer its shares to the public for the first time. Now, this means that these privately held companies are now publicly traded companies in the secondary market. Remember, we already learned about the primary markets in the previous module. The same thing is when the company gets into IPO, it basically offers themselves, it basically tells that I am open to public investments, and public investors are basically you and me, which is called as the retail investors. Now, the shares can be traded in the secondary markets by the retail investors as well as two other types, by retail investors and also foreign institutional investors and domestic institutional investors. Now, what are these investors? They are called as FIIs or DIIs, which means that they are institutional banks basically, which is called iBanks, or maybe fintech companies that want to put their money as investments in these companies. So For them also, secondary market plays an important and integral part of their earnings. Now, for a company to get listed in an IPO, there is a proper staging, there is proper steps that need to be followed. So the first step in doing so is called due diligence, which is done by majority of the accounting firms that are there. So what exactly happens in due diligence is that they check if the financials are correct, if the company is on track of what they propose to be, and also if there are any malpractices or misdoings that are done by the company. So all that things are taken by these accounting firms, and then they are reported to SEBI. SEBI is the Security and Exchange Board of India. So now they have the first step that the company has to do is they have to prepare a document called DRHP document. Now, what does this mean? This means that it is a draft red herring prospectus, which basically tells about how the company is performing, what is the potential loss that the investors can have if they invest in the company. They perform a SWOT analysis, which is called strength, weakness, opportunities, and threats. So they list out all these things in their document called the draft red herring prospectus. In order to know about this, you can visit the SEBI website and find it. I'll just show you how it is. So if you go to SEBI website, you would see something. Okay, so if you go to the home tab, filings, public issues, then you will come to this particular section called draft herring documents filed with ROC, or you can have draft offer documents filed with SEBI. If you click on that, then you can get the number of companies that have applied for their IPOs. So if I see in general case, I'm taking an example of Zomato. So I'll see when was Zomato had its okay, here it is. On April 28th, they filed this DRHP here. So if I click on it, then a window will open and I can actually see what this document is. Now, this document is a very big document. It is not a 10-page or 20-page document. It's around 500 pages document, which gets the details of everything that the company does or has done in the past or about to do in the future. So it just tells us about what are the management think about the company, and also about what are their future plans or what are their potential risks involved in the business that they are currently dealing in. So along with that, it has a brief description of if there are any legal matters that the company is engaged in. Are there any cases that are filed by the consumers against the company? Also, the document tells us about what is the management, what are the promoters of the company, who are the investors, who are the big investors that are there present in the company before getting listed to the stock market, and also if the company is pledging its shares before listing on the stock market, which means that they want to exit the company before it is listed, or they want to reduce the percentage amount in the company. So all these things are mentioned in this document in detail. All right. So this is the document that is called DRHP. So you can see that the name of the company is written here. You have written draft red herring prospectus. The date is mentioned and everything is there. So if you go through this, so as I mentioned before, they have to do due diligence and everything. So the one that helps we call it the merchant banks, which helps the company list it in the IPO. So these are the merchant banks, Morgan Stanley, Credit Suisse, Kodak, and all these things. So you have mentions of everything in this document. Now, if you see the table of contents, it has basically everything: general, the risk factors, the introduction, the offer, what they are planning to raise. For in case of Zomato, they are planning to raise around 9,000 crores from this IPO, which means that there is a fresh issue of securities worth 9,000 crores. And then there will be some promoters or some existing investors that want to exit the company or lower its share in the company, which is around 375 crores in case of Zomato. So the total amount that they are raising through IPO is 9,375 crores, around that. So this is what they are offering. And apart from that, they are also, as I mentioned in the previous module, that there's something called as face value of the stock. So they have kept their face value as ₹1. So that is how they're issuing their shares to in the secondary markets. All right, what else is there? Our business. So if I click on that, it will land me into this page called Our Business. So it will tell you basically what the the company is about, what they are doing, what they have. So we already know, let's say they have Zomato Pro, dining out, food delivery is their business and everything. So they have mentioned it, what they are doing, how many restaurants are they covering throughout India. They have mentioned it. We have around 1,31,000 something active delivery restaurants every month. So this is mentioned. You get a whole view of what this is. You get to know how the company functions from the basic level to the more complex levels in this particular document. So it will also tell you about the growth prospectus, what will happen, what has happened, its basic financials, basic, balance sheets, and all those things will also be covered in this document. All right. So basically, the company wants to sell itself in a much more positive way. So they will be displaying a lot of information that might feel like there's too much to the company, but they will be rolling out something that would be really, really helpful for the investors to, attract them to buy it in their IPO. So this is their major purpose with this document. All right, getting back to what we were discussing. So what happens is the IPO is listed. How do we know? So in your Demat account, in your Demat account, there will be a portal to invest in IPOs, to apply for IPOs. So what happens is, first is their open date, which is called the first date in which you can buy shares by a lot. Okay, I have mentioned it before as well. You buy shares in lots. So if the issue price is in a band, let's say from 75 to 79, right? This is a band. Now you can select any price in between this. So let's say if you buy 75, and they will mention it in their particular document, what is the size of one lot. If the one lot is of 25, so if you buy two lots, then it will be into 50. So this is the amount you have to pay during the issue. And remember that if you are giving your money in IPOs, it does not really mean you will be allocated that IPO. It depends totally on the company if they are willing you to give that IPO to you or not, right? So you would have first the open date, then you would have a close date in which the amount they want to receive, if they have received or not, then that would be an open date. Then comes the allocation date. So allocation date will be much later than the open date and the close date in which they will allocate it. If you have received the allocation, you will receive the shares in your Demat account later. If you haven't, then the next phase comes refund. Refund if you are not allocated any IPO. Then comes the credit to Demat account, to your account. If you have been given the shares will come to your Demat account. Then finally, it is called the IPO listing date. Listing date is the day in which the company gets first functionally traded on the stock market. That is called the listing date. Now, why do people should invest in IPOs? Now, the major purpose is that if it is a very high trending company, right, then everyone wants to put their money in. Now, what would happen? Let's just say that, I'll give you an example of this only. If Zomato's cutoff price is 79, let's say, and you're buying 50 shares out of it. Now, 50 shares, when it gets listed, let's say it goes to a price of 131 on their first day. Now, you would earn approximately how much? Let's say for 50 rupees per share on their opening day. So your time duration of investing is reduced to just 2 days, right? You will be earning 50 rupees. That's more than 20% of what you will be investing in. So you'll get a returns of that massive amount within days, which is why the compounding period is decreased with so much earnings. That is why you should apply to good companies for IPOs in which you believe your money will be grown to a higher levels in that IPO. So that is why you should invest in IPO of good companies. Now, if you are someone who is very new to the markets and who does not know much of the jargons that roll around in this particular domain, so this particular module is for you. Now, you need to understand what type of investor are you. Are you a trader? Are you a day scalper? Are you a growth investor? Or are you a value investor? So all these things will be told to you in this module. Let's clear all the conceptions and move forward. So now let's look at what are the different types of investors that are in the stock market. So it can be a day trader, a scalper, a value investor, a growth investor, or a swing trader. Now let's see what each one of them are in greater depth. So a day trader is someone who opens and closes his trades on the same day. So he does not carry forward his positions to the next day, right? Which is also known as intraday trades, okay? Which is also called as intraday trades. So market, as I already mentioned before, opens at 9:15 a.m. to 3:30 p.m. for equity stocks from Monday to Friday. So this particular type of trader would start his investing around 9:15, or throughout the day he will take his trades for a few hours, or when the market opens till the market closes. But he need to close all his position, okay? He need to close all his position by the end of this period. He can't carry it forward to the next day. So that type of trader is called a day trader. The next type of trader is called a scalper. Now this type of investor is basically who buys a lot of chunks but sells it within seconds. What does this mean? So let's just take an example. So if a person is buying, let's say, 10,000 shares of a particular XYZ company at any price, right? Let's just not get into it. Let's talk about the quantity. So quantity is 10,000 shares. Now, if the price increases by 1 rupee in, let's say, 2 minutes. In 2 minutes, the price increased by 1 rupee. Do you know how much amount of money he'll make? He'll make 10,000 rupees straight on that trade. He'll make 10,000 rupees straight in 2 minutes. It's all because of the quantity. So he's dealing in the quantity rather than the time. There are two important factors in trading. One is called the quantity. The second one is the time. Either you can make money by having lots and lots of amount of capital and just invest it for seconds. If the price moves 50 cents or like 50 paisa, or it moves 1 rupee, you sell the stock. So that is what a scalper does. He does not take trades more than, let's say, 5 minutes or 10 minutes. That's the maximum thing. So scalper makes quick money with large amount of capital. Next come value investors. Now, the goal of this type of investor is to find good firms that have been in correction. When I talk about the term correction, it means when the markets are down. Okay. So when the market sentiment is down, this value investor will buy it. And regardless if the company is there in its peak of the time or whether it is anywhere. So now this type of investor would value the company fundamentals more. So what does this mean? This would be more of like Hindustan Unilever, or let's say Infosys, or let's say TCS. So these companies are a very good buy. They are fundamentally strong companies. So he will take a bet on that companies when the market corrects. So there's always a term called buy low, sell high. So if the market is going down, he'll buy it. If the market is going high, he'll sell it, right? So he'll make money out of it. So this is called as a value investor. Next is called growth investor. Now, the aim of this particular investor is to hold on to their stocks for at least 10 years or 15 years, because he knows that this particular stock, if it is trading at, let's say, 100 rupees, it will become 1,000 or 5,000 rupees in near future, in around 10 years time or 15 years time. Now just give it a thought. What type of sector this particular investor will target, right? So what would be the future of the world in general? If I have to guess, I would say the green energy sector, because the fossil fuels are limited, the coal is limited. You can't run on fuel for longer. So you will take your bet, you will invest in companies that are into green sector. What would that be? That would be Tesla, let's say. That would be Adani Greens, any company that deals in solar energy, wind energy. So that would be a growth investor's perspective of investing in those companies. Right. So this is the goal, is to find the businesses that are likely to grow considerably as a result of rising industry and macro trends. What does macro trends mean? Similarly, in a layman term, what sector would improve in the coming future? That's the question that comes into the mind of a growth investor. Next, we talk about a swing trader. Now, this is a very interesting type of investor that keeps his trade for maybe a week, maybe 3 days, maybe 4 days. Range depends on the type of trade he's doing. So what is his target to achieve? I'll just show it with a simple graph. So let's say this is a market graph. This is the price and this is the time frame. Okay. So let's say this is first day, second day, third day, fourth day. Okay. So he'll be targeting companies that have the potential of swing trades. What does this mean? He'll look for if a company is making higher highs, which means that I'll not get into much depth of technical analysis, but I'll say that this is a rejection point of this stock. This is a rejection point of this stock. This is a rejection point at this point and this point. So if you see, if I make a straight line, so this is something that happens, which is called as a trend line, right? So if he's a swing trader, he'll probably buy the stock at this point and sell it here, right? Buy it here again, sell it here. Buy it again, sell it here. So he knows that this is how the company is making it. It is making higher lows, higher highs. So this type of investor would just look at the graphs, which is called charts, we call it, and look at the charting patterns. In order to be a swing trader, you need to know something called as charts. Right, you have chart patterns that are there, so you need to know all about that. How different types of patterns are there: head and shoulder pattern, raising wedge pattern, flag pattern. So all these patterns are there. So you need to learn about that. If you really want to learn, I can make a video on that as well. Just let me know in the comment section below. So now let's just assume that you are a very new investor to the stock market. You don't have much knowledge about how the market works. So what would be the criteria that you would decide to put your money in, right? What is the way that you would know that, okay, this is the particular stock or this is the particular company that you want to put your money in? To answer all these questions, there can be multiple ways. One could be a very easy way in which you turn on the news channel that gives you business news and listen to the stock tips that they are giving you. Right? So that can be one of the ways in which you can put your money to know which company you want to invest in. So the drawback of that particular thing is that a lot of people would be watching the same stock tip, right? Same stock suggestion that the channel is providing you. Now, what would happen is that, as I already mentioned before in the previous modules, that stock market, the price of a stock moves by the balance of supply and demand. Now, in this case, if a lot of people are looking at the suggestion to buy a particular stock, then there will be imbalance in that thing. And that would lead to the investors like you and me losing out on a lot of money. So what can be the other way around to counter this? Now, the other way is to fully understand how the stock market operates, to know what are the in-depth views that the investor look at when they are analyzing a particular company. Now, this calls for two different analysis. One is called the fundamental analysis. Second is called technical analysis. Now, what happens in a technical analysis is that, as the name suggests, it would deal purely on mathematics and algorithms that the investors make or people who analyze these stocks make. Now, this includes knowing a lot of mathematical complex equations, knowing different charting patterns, different technical elements and indicators like the moving average, MACD lines, Gantt charts, etc. Different indicators like you would have moving average, you would have MACD lines, you have different types of exponential moving average. So all these things are considered while looking at the technical analysis. On the other hand is fundamental analysis. Now, fundamental analysis is basically knowing how fundamentally strong a company is. What are their valuations? What are the proper cash flows that the company has? How strong is the foundation of the company in terms of the management? So all these things are looked upon in the fundamental analysis point. Now, it is a way of determining the intrinsic value of securities by looking at the linked economic and financial elements. So what is this economic and financial elements that has been talked about? So it's basically certain financial statements that we need to look at, certain financial ratios that we need to look at, and also look at the sector in which the company is operating. Is it the steel sector? Is it the food business? Is it the e-commerce? Or is it a financial company? So what are the different elements? Repeat. So what are the different sector in which that company is operating? That is a must to know. Then is it a monopoly in that particular sector, or does it have good competitors? So all these things have to be looked upon when you are analyzing a company to invest. Now, fundamental analysts look at everything that can influence the value of that security, of that stock. Microeconomics, macroeconomics, both are important. Macro would include how the state of economy is, how does the Indian markets are growing in general, what is the GDP growing in general. So all these things matter when it comes to macroeconomic values. Second is the microeconomic elements that would involve the company's management. Does the CEO of the company or does the chairman of the company believes in the way they are doing things? Are they constantly improving, constantly analyzing the way they are operating? So all these things have to be looked upon when you are analyzing a company to invest. Now, there are certain key elements to fundamental analysis. Number one is that fundamental analysts generally look for long-term investment. So if you are fundamentally analyzing a company, that would mean that you are analyzing a company for the next 5 years or next 10 years or so. Because in technical analysis is mostly if you're doing a swing trade, as we mentioned, or if you're a day trader, that would make more sense because the value of the stock that is increasing or decreasing in a day would matter to them. But for a fundamental analyst person, for a person who would not know more about the stock markets or much about the stock markets, then for him, long-term investments would be a better option, right? He can't afford to lose money on a day-to-day basis. He wants to put the money in a fundamentally strong company so that it can grow exponentially moving forward. Right. Second is knowing about the basic financial statement. So basic financial statements are typically 3 types. First is called the balance sheet. Second is the income statement. Third is the cash flow statement. Now, balance sheet involves knowing what are the assets and the liabilities of that particular company. Right. You have an entire sheet that describes what are the total assets of the company, what are the total liabilities of the company. Then comes profit and loss statement or the income statement. Now, this tells you about the revenue and expenses of a particular company. What is the revenue coming from? What is the expense that the company is doing? All that stuff is in P&L statement. Then comes the cash flow statement, which tells what is the actual cash in hand in the company. What are the different elements to it? Now, if you want to know more about these financial statements, we do have a course on basic accounting and financial accounting. So you can look at that to get a greater depth of these financial statements. Then comes recognizing firms in relation to the industry in which they operate. So exactly how you have to do the market research. Is the company a particular monopoly? Let me give you an example. IRCTC is a stock of Indian Railways, right? So that is a monopoly because it does not have any competitors. So it may be a good outstanding stock, but again, you have to look at different fundamentals, where they are getting their money from, revenue from, and all that stuff, right? So you have certain monopoly stocks and you have certain stocks that have so many competitors. Right? So like financial companies, you have a lot of competition in that. Banks, you have a lot of banks involved. So there are certain monopolistic companies and certain non-monopolistic companies, or the companies which have a lot of competitors. So you need to look at that as well. You need to do your basic market research on how the company would perform in the longer run. Then comes learning about the management of the company. Now, if the company is fundamentally strong, the second point that you need to look at is if the management or the board of directors of that company stand by the company, stand by its employees. Are they providing good facilities to their employees? Are the promoters of the company not too much selfish about getting money first to themselves? So all these things have to be taken. Do they have a good vision for the company in the future? So these elements are involved when you look at company for a long-term investment perspective. So next we'll talk about some frequently asked questions on what about the stock market. So we'll know about that in a greater depth. So what the most important question that people keep asking me on a day-to-day basis is, what Madhur, tell me what are the key events that impact the stock market? Now, some of that I've already mentioned in this video, but to know that in a more detailed way, I'll give you certain pointers on that. So number one is supply and demand. I've always told you there is a constant fight between the bulls and the bears. That means the ones who want the price to go up and the ones who want to sell that particular stock and want the price to go down. So the constant rivalry between the supply side and the demand side leads to fluctuation in prices. That's number one. Second could be the company related affairs. If the management of the particular company resigned all of a sudden, right, there will be a huge decline in the price of the stock. So that would be one of the reasons. If the management is not strong enough, if the management is good and visionary, the price of the stock may go even higher, right? So we can see that in case of Tesla, let's say, right? So that depends on the company related affairs. If they are very progressive, very visionary towards the future, then yes, that would be a good stock. That would be considered as a good stock. But then you have to look at the fundamentals, the technicals, and all that stuff. Third comes the investor sentiment. Now, market is a very sentimental place. What does that mean? It means that it would depend purely on the basis of how people react to situations. If people are too nervous, then they'll want to sell that particular stock, right? If people are too fearless, they would buy that particular stock more. So the fear and the greed of to get more money could also lead to the fluctuation in prices, which is called as the sentiment of the investor. Then comes the interest rate by central and federal banks. Now we know that you have to maintain a balance between low interest rates and then inflation rates. So, if whenever these things change, right, whenever these things have an impact by the RBI, when they have certain regulations that come into picture, the market reacts to it. Market reacts in a way to know if that is a positive news or a negative news. We have heard repo rates, we have heard interest rates being changed by the central banks. India has RBI as its central bank. So the things that impact it, so such news also impact the way stock market prices go up or down. Then comes political news. Now, India is a very politically strong country, right? India is a democratic country. It has a lot of political parties. So the way India is growing forward would depend on the central leadership of the company, right? So various political events that take place. Let me give an example. If company's government is open to cryptocurrencies, or are they banning cryptocurrencies? So such political news, such political governance news can lead to a lot of impact in the market, right? In the sentiments of the investors. So political news play a lot of big role in the way if there is an election that is happening, if particular political parties have changed. So that things also play a huge part in knowing whether the price of the stock is moving upwards or downwards. Then comes natural disaster. Now, this is the most recent one, and we would know about it that during COVID, the news of COVID struck and the market went down by almost 10% or more than that. So such natural disasters like COVID-19 could lead a huge impact on the country's economy as well as stock market. So if you would actually see the charts of what happened during that time, you would know that, okay, this thing was not good enough and our market crashed because there was no vaccines till then in March 2020, right? There were no hope of a vaccine, and it would seem a catastrophic affair that everything would just go on, people would continue dying. So the market was very weak at that time and it lost a lot of value. People lost a lot of money. So natural disasters can also lead to impacting the share market, right?
So after learning about stock market through the modules, now it is the time to know what you have learned so far. So we started by knowing what is a stock market, how are publicly traded companies bought and sold. Then we found out what is a stock, how are companies divide their capital into smaller chunks of ownership that they roll out in the stock market. Then we talked about what are the two major exchanges in India, stock exchanges. Number one is the National Stock Exchange. Number two is the Bombay Stock Exchange. We discussed about that. Then we talked about what are the basics of stock markets, what are the commonly used jargons that are used when it comes to trading in the stock market, whether it is the bear market, the bull market, the upper circuit and the lower circuit. Then we discussed about how privately owned companies get public, what is the process called, that is called the IPO, how it is done, what is the storyline behind it. We discussed all about that. Then we discussed what type of investor are you. Are you a trader? Are you a day trader? Are you a scalper? Are you a swing trader? Or are you a growth investor? So all these things we discussed in the module trading versus investing. Finally, we learned about what is fundamental analysis, how do we do fundamental analysis, what are the key high elements that are involved in the fundamental analysis. Finally, we also discussed what are the key events that impact the stock prices of different companies, right? So all these things we discussed in this particular course. Hope you had a fun session, and for more such videos, stay tuned to Great Learning. If you haven't subscribed to our channel yet, we request you to hit the subscribe button and turn on the notification bell. This is done to make sure you don't miss out on any of the new updates or video releases of Great Learning. And of course, if you enjoy this video, show us some love. Do like the video. Knowledge increases by sharing. So make sure you share this video to your friends, family, and whoever can make use of it. And at the end of it, make sure to comment on this video if you have any queries and suggestions. And I would be more than happy to respond to all of your comments.